You have money sitting in a bank account right now. Maybe it's $300, maybe it's $30,000. And every single day you leave it there, someone else is getting richer off of it. Here's what they don't tell you when you open a checking account. The bank takes your money, lends it out to other people at 5, 6, 7% interest, and pays you nothing. Or if they're feeling generous, 0.01%. You're giving them an interest-free loan. They're making billions. And you're getting a debit card and a thank you for banking with us email once a month. Most people think a bank account is just a place to keep money, a digital shoebox, somewhere safe. And that's exactly what the banks want you to think. Because the moment you realize your money could be working for you instead of against you, the entire relationship changes. This isn't about opening more accounts for the sake of it. It's about understanding that different types of accounts have different jobs. And when you use them correctly, strategically, like actual tools instead of just defaults, your money starts doing things. It grows. It protects itself. It creates opportunities that weren't there before. But here's the problem. Most people have the wrong accounts in the wrong places, doing the wrong jobs. They've got their emergency fund in a checking account earning nothing. Their short-term savings in a traditional savings account earning almost nothing. And they're leaving thousands of dollars on the table every year because nobody ever explained how this actually works. So let's fix that. There are 5 types of bank accounts you need to understand. Not all of them are for everyone, but the ones that are for you, they can genuinely change your financial trajectory. And the ones you're using wrong right now, they're costing you more than you think. Let's start with the account everyone has, the checking account. On the surface, checking accounts are simple. You deposit money, you spend money. Direct deposit goes in, rent comes out, debit card transactions, bill payments, ATM withdrawals. It's the hub of your financial life, the account you interact with most. And for that specific purpose, it works. But here's what's happening behind the scenes. When you deposit money into a checking account, the bank doesn't just hold on to it. They're required to keep a small fraction in reserve, usually around 10%. And the rest? They lend it out. Car loans, mortgages, credit cards. They're making interest on your money all day, every day. And in return, they're giving you access to your own money. That's the deal. Now, some checking accounts pay interest, but let's be honest about the numbers. The average interest rate on an interest-bearing checking account in America right now is about 0.04%. If you keep $5,000 in that account for a year, you'll earn $2. Not $200, $2. You can't even buy a coffee with that. So the first rule is simple. A checking account is not an investment. It's not a wealth-building tool. It's a transaction hub. You should keep enough money in it to cover your monthly expenses. Maybe a small buffer for unexpected costs. And that's it. Everything else sitting in there is dead weight. It's not growing. It's not compounding. It's just waiting. But here's where people mess up. They treat their checking account like a savings account. They get paid, leave everything in checking, pay their bills, and whatever's left just sits there, month after month, year after year. And they wonder why they're not getting ahead. The uncomfortable truth? Your checking account is designed to keep you broke. Not maliciously, but structurally. It's built for access, not accumulation. The easier it is to spend money, the less likely you are to save it. Every app, every debit card, every instant transfer is optimized for spending. That's not an accident. So here's the move. Use checking for what it's designed for. Bills, groceries, gas, rent, monthly expenses. Keep 1 month of expenses in there, maybe 2 if it helps you sleep better. But everything else, it needs to leave. Because every dollar sitting in checking is a dollar that's not working for you. Now let's talk about the account people think is for saving. Traditional savings account. This is where it gets frustrating. Because savings accounts sound like they're supposed to help you save money. It's in the name, but the way most of them work, they're barely better than checking. The average interest rate on a traditional savings account right now is about 0.4%. That's better than checking, sure, but let's do the math. If you keep $10,000 in a savings account at 0.4% for a year, you'll earn $40 before taxes. After taxes, depending on your bracket, maybe $30. Meanwhile, inflation over the past few years has been running at 3, 4, sometimes 5% annually. So while your savings account is earning you $40, the purchasing power of that $10,000 is decreasing by $300 to $500. You're not saving money, you're losing it in slow motion. And here's the thing the banks know. Most people never move their money. They open a savings account when they're 18 or 22, or whenever they first get serious about adulting, and they just leave it. Same bank, same account. Same terrible interest rate. For years, decades even, the banks are counting on your inertia. Because as long as you don't look for something better, they get to keep lending out your money at high rates while paying you almost nothing. It's not illegal. It's not even unethical by banking standards. It's just the deal. And most people never realize they can negotiate a better one. But here's where it gets interesting. Not all savings accounts are created equal. There's a different type of account, one that most people have never even heard of, that changes everything. It's called a high-yield savings account. And the difference between a traditional savings account and a high-yield savings account is the difference between losing money slowly and actually building wealth. Let's talk about high-yield savings accounts, because this is where the game changes. A high-yield savings account works exactly like a traditional savings account. Same FDIC insurance, same protection, same basic function, but the interest rate, completely different. Right now, the best high-yield savings accounts are paying somewhere between 4 and 5%, some even higher. Let's run the same math. $10,000 in a high-yield savings account at 4.5%. After 1 year, you've earned $450. That's more than 10 times what you'd earn in a traditional savings account. And yeah, inflation still exists, but at least you're keeping pace with it. Maybe even beating it slightly. Now, $450 might not sound life-changing, but here's what happens when you scale it. $20,000 in a high-yield account? That's $900 a year. $50,000? Over $2,000. You're getting paid $2,000 just for putting your money in a different account. Same risk, same accessibility, different bank. So why don't more people do this? 2 reasons. First, most people don't know high-yield savings accounts exist. The big banks, the ones with branches on every corner, don't offer them. Or if they do, they're buried in the website with requirements and minimums that make them inaccessible. Because those banks make their money on the spread, they pay you nothing, lend at high rates, and pocket the difference. High-yield savings accounts are mostly offered by online banks. Ally, Marcus, Discover, American Express. Banks without physical branches, which means lower overhead costs, which means they can afford to pay higher interest rates. But because they're online only, people don't trust them. Or they just don't think about switching because their current bank is fine. Second reason people don't switch? Friction. Opening a new account takes time, 30 minutes maybe. You've got to transfer money, set up direct deposit if you want, link it to your checking account. It's not hard, but it's effort. And for most people, the mental cost of that effort outweighs the financial benefit until they actually do the math. Here's the uncomfortable truth. If you have money sitting in a traditional savings account right now, you are voluntarily giving up free money, not hypothetical investment returns, not risky stock market gains. Guaranteed FDIC-insured interest that you're just not taking. Because switching accounts feels like work. The banks know this. They've studied it. They know that even when people become aware of better options, most won't switch. Inertia is their most valuable asset. Your inertia is making them rich. So let's pause here and talk about what this means practically. You need at least 2 accounts, probably 3. A checking account for daily transactions, a high-yield savings account for your emergency fund and short-term goals. And here's where it gets strategic. You might need a 3rd account as a buffer. Let me explain. One of the biggest reasons people overspend is because all their money lives in one place, the checking account. When you look at your balance and see $5,000, your brain doesn't automatically separate bill money from savings money from fun money. It's just $5,000. And that makes it easier to justify purchases you shouldn't make. But when you split your money into different accounts with different jobs, something psychological happens. You stop thinking of your total balance as available funds. You start thinking in categories. This account is for emergencies. This account is for rent. This account is for saving up for a car. And suddenly, spending from the wrong account feels wrong, like you're stealing from yourself. This is why some people swear by having multiple savings accounts. One for emergency fund, one for a house down payment, one for a vacation. Not because the money is actually separate, it's all still yours, but because the mental accounting creates discipline. You're less likely to raid your emergency fund to buy concert tickets if that money is sitting in an account literally labeled emergency fund. Now, you don't need to go crazy with this. You don't need 15 accounts. But the basic structure makes sense. Checking for spending, high-yield savings for storing, and maybe a second high-yield account for a specific goal if that helps you stay disciplined. But here's the catch, and it's a big one. High-yield savings accounts are not risk-free just because they're FDIC insured. The risk isn't that you'll lose your money. The risk is that the interest rate will change. Here's what they don't emphasize when you open a high-yield savings account. The rate is variable, not fixed. The bank can change it whenever they want. And they do, constantly. Right now, rates are relatively high because the Federal Reserve has kept interest rates elevated to fight inflation. When the Fed raises rates, banks raise the rates they pay on savings accounts. But when the Fed cuts rates, which they've started doing, those high-yield savings rates drop too fast. A year ago, Some high-yield accounts were paying over 5%. Now, many are closer to 4. In another year, they could be at 3 or 2 or lower. You don't lose the money you've already earned, but your future earnings shrink. And if inflation stays elevated while rates drop, you're back to losing purchasing power even in a high-yield account. This is the game. The banks give you a competitive rate to attract your deposits. Then, once you're in and comfortable and not paying attention anymore, they quietly lower it. Maybe you get an email notification buried in your inbox. Maybe you don't. And unless you're actively monitoring rates across different banks, you won't even notice until months later when you check your statements and realize you're earning less than you thought. So here's the uncomfortable reality. A high-yield savings account is better than a traditional savings account, no question. But it's still not a wealth-building tool. It's a wealth-preserving tool. It keeps your money safe and accessible while hopefully keeping pace with inflation. That's valuable, critical even, for emergency funds and short-term savings. But if your goal is to actually get richer, not just stay even, you need something else. Let's talk about the account most people are afraid of, the money market account. Money market accounts are weird. They sit somewhere between a savings account and a checking account. They typically pay higher interest than regular savings accounts, sometimes competitive with high-yield savings accounts. But they also come with limited check writing abilities or debit card access. So you can spend the money if you need to, but there's friction. Not as much as a traditional savings account, but enough to make you think twice. The advantage? Flexibility. If you've got a chunk of money that you don't need tomorrow, but might need in 3 months, a money market account gives you decent returns without locking you in. Some people use them as a bridge between their emergency fund and their checking account, a place to park money that's earmarked for a specific purpose, but not immediately needed. The disadvantage? Money market accounts often require higher minimum balances. Sometimes $5,000, sometimes $10,000. And if you dip below that minimum, you get hit with fees or your interest rate drops. So they're not for everyone. If you're living paycheck to paycheck or building your first emergency fund, a high-yield savings account makes more sense. But if you've got $20,000 sitting in a checking account because you're saving for a house down payment in 6 months, moving it to a money market account could earn you an extra few $100s while keeping the money accessible. It's not transformational wealth, but it's free money you wouldn't get otherwise. Now the fifth account. This is the one most people don't think of as a bank account, but legally, it functions like one. It's called a certificate of deposit, a CD. Here's how CDs work. You give the bank a lump sum of money, they agree to pay you a fixed interest rate, and in return, you agree not to touch that money for a set period of time. 3 months, 6 months, 1 year, 5 years, whatever term you choose. If you withdraw early, you pay a penalty, usually forfeiting some or all of the interest you've earned. CDs pay higher interest than savings accounts because the bank knows they have your money locked in. They can lend it out with confidence that you won't suddenly pull it back. Less risk for them means higher returns for you. Right now, depending on the term, you can find CDs paying anywhere from 4 to 5% or more. The strategy here is called a CD ladder. Instead of putting all your money into one 5-year CD, you split it up. Put some in a 3-month CD, some in a 6-month, some in a 1-year, some in a 2-year. As each CD matures, you either cash it out or roll it into a new one. That way, you're always earning the higher rates of a CD, but you've got regular access to portions of your money as each term ends. The downside? CDs are completely inflexible. If an emergency happens and you need that money, you're either paying a penalty or you're stuck. So CDs only make sense for money you know, with absolute certainty, you won't need. Maybe you're saving for a down payment, and you know you're not buying a house for at least 2 years. Lock some of that in a CD. You'll earn more than a savings account, and the lack of access actually helps with discipline. But here's the irony. Most people who would benefit from a CD ladder never set one up because it sounds complicated. And most people who do set up CD ladders are the ones who already have enough money that the extra percentage point doesn't materially change their lives. Let's zoom out. You've got 5 types of accounts: checking, traditional savings, high-yield savings, money market, CDs. Each one has a different job, and the difference between someone who builds wealth and someone who stays stuck isn't intelligence or income or luck. It's knowing which account to use for which purpose. Here's the hierarchy. Your checking account holds 1 to 2 months of expenses. That's it. Your high-yield savings account holds your emergency fund, 3 to 6 months of expenses, depending on your risk tolerance and job stability. Your money market account, if you have one, holds short-term savings for goals within the next 6 to 12 months. Your CDs hold money you don't need for at least a year, maybe longer. And anything beyond that? Anything you don't need for emergencies or short-term goals, that money doesn't belong in a bank account at all. It belongs in investments, index funds, retirement accounts, real assets. Because even the best bank account is only going to keep pace with inflation. It's not going to make you rich. It's going to keep you from getting poorer. That's the part people miss. They think if they just find the right savings account, they'll build wealth. But savings accounts aren't for building wealth. They're for preserving it, for creating stability, for making sure that when life happens, when the car breaks down or you lose your job or the furnace dies in January, you don't have to go into debt or sell investments at the wrong time. The real wealth building happens elsewhere, but you can't get to elsewhere if you don't have the foundation right. And the foundation is having your money in the right accounts, doing the right jobs, earning what it should be earning instead of sitting dead in a checking account, making your bank rich. Here's what keeps me up at night about all of this. The system is designed to take advantage of people who don't ask questions. The default options are almost always the worst options. The big banks with the most advertising and the most branches are paying the lowest interest rates. The accounts that require the least effort to open are the ones costing you the most money to maintain. And the information asymmetry is deliberate. Banks don't advertise their savings account rates in commercials. They advertise convenience, mobile apps, ATMs everywhere, customer service, which are all fine things, but they're not wealth-building things. They're comfort things, and comfort is expensive. The average American has about $8,000 in savings. If that money is sitting in a traditional savings account, earning 0.4%, they're making $32 a year. If they moved it to a high-yield savings account, earning 4.5%, they'd make $360 a year. That's a difference of $328 for doing nothing except opening a different account. Now multiply that by millions of people, billions of dollars in savings, sitting in accounts earning nothing, while the banks lend that money out at high rates. It's the biggest wealth transfer that nobody talks about. Not because it's hidden, the information is public, the rates are disclosed, but because most people never look. They trust that their bank is looking out for them, and their bank is looking out for them, just not in the way they think. So here's the real question. If this is all true, if moving your money to better accounts is this easy and this beneficial, why doesn't everyone do it? Part of it is inertia. We've covered that. Part of it is trust. People stick with the banks their parents used, even when those banks are objectively bad deals. Part of it is just not knowing. Financial literacy isn't taught in schools. It's not a common dinner table conversation. And the banks certainly aren't going to educate you on how to leave them for a competitor. But there's something else, something deeper. Most people don't think they have enough money for it to matter. $8,000 in savings? That's not real money. Not compared to people with six-figure portfolios. Why optimize for a few $100s a year when there are people making that in a day from investments? And that mindset is exactly what keeps people stuck. Because $300 a year is $300 a year. It's not nothing. It's groceries for a month. It's a car payment. It's a start. And more importantly, the habit of optimizing, of asking whether you're getting the best deal, of not just accepting defaults, that habit compounds. The person who moves their savings to a high-yield account is the same person who eventually starts investing, who negotiates their salary, who reads the terms before signing. The person who leaves everything in a checking account because it's fine is the person who stays fine. Never bad, but never better. Here's the part nobody wants to hear. You can do everything right with your bank accounts and still not get rich. You can have your checking optimized, your emergency fund in a high-yield account earning 4%, a CD ladder perfectly structured, and in 10 years you'll have more money than you started with. But you won't be rich. Because bank accounts don't make people rich, they make people stable. And stability is the prerequisite for wealth, but it's not wealth itself. The real move is this. Get your foundation right. 1 to 2 months of expenses in checking, 3 to 6 months in a high-yield savings account, anything extra in CDs or money market accounts if the timeline makes sense. And then everything else goes to work. Investments, retirement accounts, index funds, real estate if that's your thing. Assets that actually grow, not just keep pace. But you can't skip the foundation. The people who try to jump straight to investing without an emergency fund are the ones who end up selling their investments at the worst possible time because they need cash. The people who chase high returns without stability are the ones who blow up spectacularly when life doesn't go according to plan. So maybe the 5 bank accounts aren't what make you richer. Maybe they're what stop you from getting poorer. And in a world designed to extract money from you at every turn, not getting poorer is a radical act. The question isn't whether you should optimize your bank accounts. The question is, why haven't you already? And if the answer is inertia, or trust, or just not knowing it mattered, well, now you know. What you do with that information, that's up to you.